Welcome everyone. Thank you for participating to our webinar today. I'm Laura Baldin, Head of Sales and Marketing for Hedge Invest. Here with me, Alessandra Manuli. She's the CEO for Hedge Invest. So, as you know, we started a partnership with Banbridge and through them with Tellworth Investment back in December last year. We are very happy for that, and Tellworth Investment is managing a market-neutral European equity fund. We think that finally, after many years of overperformance for ETFs and long-only product, the market regime has changed, and so hopefully there is a favorable environment for this kind of strategies, or I would say a positive environment for market-neutral and long-short in general. So to cover this topic today with me, there is Paul Marriage, is the founder and portfolio manager for HI European Market Neutral, and also Fred Batoua, co-portfolio manager for the fund. At the end of the session, you might ask some question using the chat system, or anytime if you want to ask something. So with that, I'll turn it over to you, Paul. Thank you.
Okay, well, thank you very much, everyone, for listening in this afternoon, and thank you very much for that introduction from Laura. It's a great privilege for us to take on this strategy from Hedge Invest back in December. I used to run European long-short money many years ago, about 15, 20 years ago, but I've been mainly running UK long-short money for the last 15 years at Cazenove and Schroders. And then in 2017, just nearly 3 years ago now, myself and my partner John Warren, who've been running the UK strategy since 2005, decided to launch Tellworth Investments, and we left Schroders to do this. Schroders were actually happy about that. They were pleased to see us go. They were happy to see us go our own way, and we have a partnership with them to run UK funds as well. So we're really used to doing partnerships with high quality asset management companies. So that's a good place to start with our relationship with Hedge Invest. We've got a pretty small team at Tellworth. We're all pretty focused on what we do. We run about €1 billion of assets, and that's in the UK long-short strategy, which we're quite well known for in the UK and slightly in Europe as well. UK long only, where we have a very big market share in wealth management. And we also have now the European fund that we're talking about today with Hedge Invest. So myself and Fred run the European fund. I use my market experience and knowledge of how to run a long-short strategy, which I've garnered over quite a long period of time now. And Fred is a very experienced long-short European guy who joined us in February this year, specifically to take on this fund. The poor fund had to just deal with me for a couple of months, and then we got Fred along to give us some real in-depth stock expertise in Europe. Fred, do you want to just introduce yourself?
Sure, yeah, nice. Thanks, Laura, and for inviting us to this webinar. I joined Tellworth early February, met Paul. I was at Chiltern before. Chiltern is, I was in the European investment team as a very senior equity analyst in charge of some sectors. I was per se in charge of the sectors from a fund management perspective. We were 3 there, and Paul and I met end of last year, and I thought that this was a very exciting opportunity to join Tellworth, which is a very experienced team on the UK side, on the long short and long only UK, and I thought it was, in my opinion, a proper synergetic deal to join Tellworth to run this co-run this European long short fund. I've worked in finance for 20 years. I started at Goldman Sachs in 2000, left Paris, where I was an intern at Exane BNP Paribas on the sales side, joined Goldman on the sales side as an equity analyst specialized in consumer. Worked for sell side and buy side, and joined the buy side in 2013, definitely from after having worked at Bank of America Merrill Lynch for 5 years. I've got a European and US experience on the equities. The US background helps me as well to understand the read across, because I think Europe is, even if lives on its on its own planet with its own risks from a geographical perspective, and being a zone which is politically not completely integrated yet, as we've seen. It's still very important to have a US background, in my opinion. The US leads specifically in some areas like technology, so you need to know to have an eye on the US side. Paul and I and the rest of the team are very complementary, which, in my opinion, is very important to have the UK side, because 20% to 30% of the book is basically UK on each on the long leg and on the short leg, so we can share a lot of things. So I'm very pleased to have joined Tellworth. It's a robust company with, as I said, a lot of very good fund manager and analysts. So yeah, that's me in a nutshell.
Thanks a lot, Fred. That's a very good introduction. You're too nice about us. So the rest of the team, just to briefly mention the rest of the team, they're important guys. We've got Seb, who's our data and quant guy. Seb's a very well-known guy in the UK for his unique UK data, which is now rolling out into Europe for us. So that's nowcasting, looking at data trends. JP Hodder-Williams is our equity trader, ex-head of trading at GAM, so another absolutely top-notch guy, very experienced in dealing European equities. James Gurlis is our head of research and responsible. So he's leading our efforts to make our strategy, which is already quite ESG friendly, even more focused on doing the right things from an ESG perspective. You've got John, who's my co-founder. John helps run a similar sort of strategy in the UK with Seb. So we have a kind of European market neutral and a UK one as well. So that's a good balance, in addition to our dynamic strategy. And then next week, we have a new UK long short guy called Johnny Smith joining us from CZ Capital. So I won't mention too much about Johnny now, but hopefully he'll have some good ideas for the fund as well. Just my son bringing a cup of tea. Maybe we can move along now to the next slide. Great. So what we've got here is our UK record. Hopefully many of you met me in the past and looked at our long-term record in the UK. We run two long-short strategies. They're both Schroeder funds, and we launched them at Cazenove in 2005, the offshore version, and the onshore version in 2009, both at Cazenove. Schroeder's bought Cazenove in 13. And then when we started Tellworth, we did a deal to carry on running them for Schroeder, so that's very much our data. And you can see we've got a really solid long-term record. We've made pretty consistent returns and thankfully not really had too many periods of losing a lot of money. So we had a tough time in 14, bad stock picking. So, you know, you learn when you run a strategy, you remember the times you lose money more than you remember the times you make money. And it's important to learn about the mistakes you make when you lose money and to hopefully not make them again. So 2014, we were too biased in small caps and our stock picking was poor and the shape was bad. And we'll talk about shape in this fund later. 2018, it was a pretty tough year in the UK with people talking about Brexit and stuff. That wasn't a bad result. It was annoying that we ended just negative. We had a very bad December. It was an okay year. Overall, our strategy was okay. It fared okay through Q4 when a lot of people struggled. Bit disappointing, but overall, very happy to be delivering that kind of long-term record. And we really want to emulate that with this new fund we've taken on with hedge investors. There's no reason why we can't do that again. It's a similar strategy in many ways. And just rolling on there, you can see that month by month record as well for you. Just see not too many big negatives. You know, if you've got any specific questions about this record, obviously we'd be really pleased to take them. So how do we run the fund? So Fred's going to go through the process. So he's going to take us through the stock picking process. I'm just going to talk about some kind of top level stuff about the fund to start with. Market neutral, yeah, so it's UK, including Europe, including UK, market neutral, large cap, liquid. So those guys who have met us before will know that in the UK, our history has been quite small mid cap bias on the long book. We don't have that here. Not today, and I don't think we'll ever be small cap in Europe. We might have a few more mid caps in the future, but liquid large caps is a real focus for us here. Bottom up stock picking, meeting management teams, going to conferences, doing trips when we could do them, hopefully in the future, very much what we do. Real focus on capital protection. We've always got a fully populated short book here. We're not going to take a punt. We're always going to be there to show good capital protection in difficult markets, and we really showed that very well this year. I mean, what a time to take this fund on. You know, thankfully, so far, we've really proven to investors that we had the tools in place to protect capital in the toughest market I've ever worked in. So bottom up, stock picking, looking at factor risk. Factor risk is really important at the moment. This market shape is changing a lot. We can see it every day, value growth. And how do we navigate that? We can have a skewed portfolio that's really good for one scenario, but really bad for the other scenario. Balancing that is a really important skill set to have. And we need to be replicable and scalable. So we need to keep using the process again and again to be able to grow the fund for the long term. It's about 100 million euros today. So long-term record is good. So I think, experience is a good thing. It's an adjacent market. As Fred mentioned, 30% of this strategy is in the UK. It's helped us already this year with the European short bands. We could go into the UK and find lots of good ideas. We've got the proprietary models and data screens that Seb's built. Rolling those out to cover more European areas is going to be really helpful to us. Seb and Fred have already been working together on a lot of quant stuff and how to look at the portfolio using some of our tools. We outsource our risk reporting to Landy Partners. Landy Partners are a bunch of guys, ex-New Finance Europe, who also ended up at Schroders for a bit. A very experienced risk team. We really like them. We used to sit next to our risk team at Schroders. We had a good relationship with them. So replicating that at Landy is brilliant for us, and that's going well. And as Fred mentioned, we've expanded the team to be able to take on this strategy. So from here, I'm going to ask Fred to take it on a bit and just try and explain how we pick stocks and hopefully how that will build a profitable money-making portfolio for investors.
Sure. Yeah. Thanks, Paul, for introducing the core of the process. So the way we work is on the European side, large caps. So essentially, we are trying to fish within a pond of large cap stocks, which roughly we estimate to be around 800 stocks, 810 stocks, which are stocks above 2 billion market cap with an average daily volume. More important than the market cap is the liquidity. We want to be very liquid on this portfolio and product. So we typically have stocks above 3 million euro of average daily volume. Quite important, especially when the liquidity dries up, as we've seen. You need to be in liquid name. That's what we've decided to be in this fund. The way we work is very process driven. So I've worked extensively over the years on this way of selecting stocks. So the way of selecting stocks is, if you look at this, what I would call this channel or funnel, is basically reducing the universe to the stocks and the sectors which are showing the best features. So obviously you would say it's obvious because everybody is looking for the best stocks, but the best stocks, it seems to be self, automatic, but it's not. What we do is not at all what I would call systematic, but part of the process is filtering, quantitative and fundamental filtering. So the stock that the way to reduce the universe is basically by increasing the probability to have stocks which are showing incremental acceleration or incremental sales, earnings, margins, something that is basically on a relative basis accelerating. So even when things turn very badly, as we've seen in March, you try to be positioned or to try to find the stocks that are on a relative basis going to have better chances to have earnings growth, sales growth, and acceleration. So part of this filtering is what I would call quantitative, because part of that it has to do with also the flows that are coming into the sectors, institutional ownerships of stocks, but the majority, 80% of the screens, so they are proprietary. We use different one software and some Bloomberg linked, I should say, or Bloomberg fed. The feeding is also from Bloomberg. It's not what I was. It's proprietary. It's not completely. The way we basically build that is by, as I said, focusing on the incremental. So anything which is incremental on a relative basis. So that's the way we reduce from 800 to roughly 200 stocks. Going further down, the stocks that we want ultimately to have the core of the long portfolio and the core of the short portfolio has to be in a box which encompasses the best fundamental, as I said, on a relative basis, the best technicals and the best quantitative. Quantitative being having to do with the way the sector works on relative to the other sectors. Maybe we can move on to the next slide, which goes probably a bit deeper into the process, to the stage 1 and stage 2. So the sectors are all ranked on a relative strength basis. We try to identify stocks within sectors that are progressing. So a progressing sectors will be a sector where not only flows are going into the favor, but also so the rotation helps the sector. That's point number 1. But also the fundamentals are getting incrementally better. Typically during the March period, you want it to be the stocks and the sectors that were coming out of our analysis, and that we went further down into a pure fundamental analysis, were more defensive, because on a relative basis, you could see that the earnings revisions, the expectation of sales, expectation of earnings, were basically much more resilient on the way down. So some have to do with projection, earnings expected, some have to do with recent acceleration or recent strengths on pure fundamentals over the last few quarters and on a sequential basis. So this is basically the way to reduce the universe. The next leg will have to be, probably you can move on to the next slide. Once we have this universe of stocks, so the why is this stock coming up in the screen? How much discrepancy can we find on a forward basis? And then we check it out. So the checkout the checkout is basically the pure fundamental analysis. And when we've done the why, how much, and let's check it out, we increase our probabilities to get the right stocks at the right time. Why? Because, as I said, we know, being in the screen, that it's just past the threshold of having something going on fundamentally better than the rest of the market. And then the check it out has is the phase which I will call purely fundamental, when we have to do calls with management and or call with analysts to try to understand why the stock is showing up. If it's showing up, it's probably because there's something incrementally better in the story than the rest of the market. So even in a bad market, again, you always find stocks that are relatively showing strengths from a fundamental perspective, technical perspective, and flow perspective. The fundamental analysis, we don't reinvent the wheel, but we try to see where is consensus. Is consensus making sense? Which analysis is going out? So who's very out of consensus on the way up or down? So I usually like to talk to someone who's very low or someone who's very high, looking into the models that we can send from the sell side, the reverse DCF, does it make sense? And do the earnings have a chance to surprise on the way up or on the way down? So that's the framework, is around mixing the quantitative phase, fundamental phase, and technical phase. The technical phase is only to enter, exit, or getting a bit more precise, and also for the sizing of the position. So maybe you can move to the next one. Yeah, so the short book, essentially, what you can do on the long side, you can do as a short side. So screening the sector that are showing better trends and stocks within sectors showing better trends. You see stocks that are basically showing weaker trends on a relative basis from a earnings expectation and past earnings acceleration, sales, margin, return on equity. So what we try to, the way to come up with a short book is sometimes proper shorts, so short that are showing the deterioration of fundamentals, that are structurally challenged, that are quantitatively worst because the money is going out of the sectors, they are poorly ranked, and some of those stocks will be short will be stock specific, so a short that is not always against the long, and some will be when we have long stocks within one sector, we try as well to find shorts that could basically match on the other side. So not the entire book is not built around pure pairs, but there are some way of playing pairs of thematics, I should say. I could give you example later on. On the technical side, the shorts work the same as the longs, except that it's the opposite. So you could see that a technical support is being broken. You can see a sell-off with very large volumes, which usually tend to show that institutional try to exit some of those positions, and classical double top or buying exhaustion patterns. Next slide, please. Yeah. So on this slide, it's the ESG. So maybe Paul, you want to?
Yeah, absolutely, Fred. Yeah, well, I think, as I said right at the beginning, we're quite lucky at Tellworth because before people started talking about ESG a lot, we had quite an ESG friendly approach. We've never done high risk mining, oil and gas, some of the spicier ends of the UK market, betting and that kind of thing. We've always actually sort of got ourselves in quite a good place to start with, always engaging with company management teams. We're always independent. We're not doing what other people tell us to do. But we're not going to tell companies how to run themselves. We're not active managers in this activist managers, rather we are active, but not activist. We're not trying to tell companies how to change their strategy. No, that's not our skill set. We're more about shares and share prices. But we'll vote on everything, and we take advice on voting. In the UK, we have, as one of our clients, one of the leading ESG-led institutions, so that they're a fantastic relationship with us to help us decide, what the latest trends are. So it's great to have them as a client, and that really helps us in all our decision making across Europe. And one of the other things that we use, which I think is unique, is we retain progressive value management to work on really difficult situations. So, when a situation has got too complicated for us, to be honest, this fund is too young in our ownership to have a problem situation yet. Touch wood, we won't have to, but clearly when you run money in for a period of time, things do go wrong. So we get an external manager to help us out when things go wrong, because that gives us a clearer vision, a better direction, and a quicker solution to companies' liquidity problems. So that's an important part of our overall ESG. We're here to all the normal codes you'd expect. And I think what's kind of happened is our basic process was ESG friendly, and we're just evolving it to make sure that it is suited to everybody's ESG-led approaches now. And most of the clients we've met are very happy with our ESG approach and feel that it fits the criteria they need for their underlying clients. Next slide.
Yeah, thanks for showing up some of the stock ideas. So those are ideas that some of them are still live in the book, some have been closed, especially some of the shorts have been closed. They've been very successful. I could actually start with some of the shorts. Hammerson and ITV. So basically those shorts are typically short that we were shorts Hammerson all the way since I started almost. This is the idea behind, and how we found the stock is probably more important than explaining as much important as explaining the why. So the way to find a short like Hammerson, we are long residential real estate in Germany, specifically because we think that the German real estate is completely undervalued within Europe. It's one of probably the most undervalued across the country. If you compare to Berlin to any place in the rest of Europe, despite having some laws that are a bit specific in terms of rent increase, it's very defensive. So we were happy to be long Vonovia, for instance. And on the other side, the structurally most challenged real estate companies are shopping mall. Nothing new there. Obviously, it got accelerated with the crisis because people have left shopping malls to go on to shop online. So Hammerson is within a sector or subsectors which is very challenged. Also, the issue they have on top of it is that their balance sheet is completely stretched. So the loan to value is very high. So it's structurally challenged, but also within the sector, it's one of the worst, if not the worst. The rental income was already negative pre-COVID. So you come into a problem which is what I would say not a structural, but an additional massive problem like COVID, with a weak balance sheet and already having some top line or sales issues on a very heavy balance sheet. So it's it's like basically a big hedge fund that has to unwind its position with no buyers of assets. So that's an example of a good short that were as well used with on the other side, almost pairing some of the long that we had in the real estate space. ITV, very quickly in one line, I mean, it's one of the largest leading commercial free-to-air TV. Free-to-air is very much challenged by streaming. They're very late, as all the European TV, to move to a streaming mode, and Netflix has basically added 120 million or plus of customers since it started. So they're basically eating their lunch. And again, balance sheet a bit heavy, very high fixed costs. So when your top line or your sales goes down, your earnings get massively impacted. So we went short ITV into this crisis. Two core long that we still have and that we are happy to keep despite the current rotation or risk of rotation for more value are ASML and London Stock Exchange, two very good assets. So typically we bought those assets or increased our position in the case of LSE during the March sell-off. ASML is probably the best or one of the best technological company in Europe. What they make is unique. They are the only one to make the EUV technology. So they make machines that are used to manufacture chips. And in their sub-segments of lithography, they've got 90% plus of the market. So it's a complete dominant situation. Earnings are going to double over the next 4 or 5 years. Maybe the cycle might be a bit different because of what we see. So it could be more 5 years and 4. So we could have a lag, but it's a very high margin business, very high return on equity. I know I've been knowing this business for a long time. It's a core long. And London Stock Exchange, another one which in our view has been a great long, it's almost at its all-time high. The London Stock Exchange obviously being a unique asset, no need to explain what the pure exchange is, but the exchange is only a small part of the business now. The majority of this business is what I would say recurring businesses as opposed to volume on the market. So the recurrency of the business is due to the London clearing house, to the FTSE Russell. They own the FTSE Russell, so the passive money. Each time there's a dollar coming, it's like a tax that they take on it. And it's a cheap asset. And they just did a massive deal buying Refinitiv, which is adding more recurring revenue. So it's and with lots of synergies. So it's to us a very defensive way of playing growth because it's not very expensive on certain times EBITDA, despite running. Despite growing 5% their revenues and 10% earnings due to the synergies with Refinitiv. So those are examples of what I would call core longs, core shorts that we had to close because they went down just too much. So yeah, I think it's a good reflection of the way we work. The short book has to move a bit more than the long book. Yeah, I think it's a good example.
Okay, thanks, Fred.
Yeah.
So you might want to pick up on.
Yeah, Paul, I was saying.
Maybe I'll hand over to Laura now to open up for questions.
No, I'm saying, of course, the fund has a few months of track record, but it has been quite a test, say, and a lot has happened into the market. So I think it could be interesting for people just to understand where your approach is maybe different from others, how you ride this current volatility. And in particular, we have seen, apart from March, where of course you protected very well the capital, also May has been a lot, end of April and May has been a lot of a challenge for other market neutral because of sector and factor rotation. So I would say just to point out how you were able to manage this factor exposure, it could be very interesting for people.
Yeah, so I think one of the key things when we look to manage a portfolio is to make sure that we don't have too much of a skew. And it's quite easy when you have a portfolio that's working in one week to think, well, actually, this is going to be fine next week and the week after. But we all know that the market doesn't operate like that. So it's one of the things we've learned over the years in the UK is to make sure that we don't end up too skewed in a position where it's only one type of market conditions that will make the fund make money and every other type of market conditions it will lose. So I think one of the things we've built into this strategy is a breadth of the book and a lot of flexibility. So we can, there's no doubt that our long book with our long-term growth, quite defensive tilt served us really well for the first 3-4 months of this year. And then we've had to change things a bit. That was pretty good at the beginning of this month, for example. And then as we've reshaped the book, as things are reversing now, it's a more challenging environment for the fund, but it can ride it a little bit better because it's got more flexibility. Fred, maybe you could talk a little bit about the sort of tools you use to give us the flexibility, like sector shorts, etc.
Yeah. So the way we manage the book is as I said, it's built by blocks. So you don't have only pairs, but you don't have only long that we like and short we don't like. And the way to proceed to avoid having this, the biggest problem has been the rotations. So we've been pretty. We went into the problem in February, or into the market crisis, with a reduced growth, a net that was as well neutral, so basically not taking risk. We quite quickly saw that the problem was pretty large in terms of earnings downgrades, in terms of the economy being shut down. So the short book was acted very well. A lot of our shorts, some were UK ones, inheriting from the January period where Paul and the team started. We increased some of those UK shorts specifically in travel and leisure, and that period was, in a way, I'm not going to say straightforward, but it was all about capital preservation. We increased the consumer staples. We increased anything which had high visibility on earnings. Some of the name I mentioned, like London Stock Exchange, obviously goes down less than very cyclical stocks. So we moved the book in a quite defensive way all along. But when March offered us a massive dislocation, we took the benefit of going long. Some of the names that we were seeing from a valuation perspective were making no sense. In February, when I started, I said to Paul, even if the book has to be what I would say factor neutral, there are a lot of very high quality companies that were super expensive. They became much less expensive in March. So obviously we built the book and increased some of those very high quality stocks, and it played really well. On the short side, each time you are adding names, you're trying to think that it doesn't imbalance the rest of the book. So that's the way we managed through March, I would say, February and March, and in same with April. So the biggest challenge, in my opinion, as Paul said, is to try to neutralize a lot of the factors, because we are in a market where rotation are absolutely massive, because the expectation of earnings have never been so dispersed. It's the highest dispersion of earnings expectation in probably since 2008, 2009. Because of that, the market is moving sometimes very abruptly and aggressively, like we've seen today, for instance, between what I would say high quality growth, high quality, low quality, and high growth, low growth. So what we try to do is to constantly think about not being exposed too much to some of those factors, but to favor stock picking based on the process that I've described. Some of the risk that we try to offset quite on a weekly, if not daily basis, is to try to be careful on the short side, because some of the structural shorts are very, very extended to the downside. Some of those stocks are very cheap, even if you consider that the earnings are going to be cut by at least what the expectations are, 30, 40, 50% for this year, with some form of rebound, even if it's not a V-shaped rebound. Some of those earnings on next year or the year after, which is what the market is trying to look at, get really cheap. So in that kind of situation, like Hammerson is a good example. This shopping mall we closed last week, it's probably up like 15% today on a very big value day. So ITV, same, we're out of those, and we added some shorts that were more in consumer staples. So we've added names like Unilever over the last few weeks, Kerry Group, which is a very good company doing ingredients, food ingredients, so very steady. But guess what? It's priced for perfection, and the growth is like 2 to 3% on the top line with very little margin accretion. So we try to really be careful not to be too exposed to some factors. We build the long book by blocks, some being pairs. One example of a pair which is not a natural pair is we are long Eiffage. Eiffage is 70% of Eiffage is basically they own the concession for the roads in France. So toll roads, it's 70% of the business, 30% being construction related. So we are long this asset because we think that people will drive for the summer, also because the debt issue is basically non-existent. There's no covenant at all problem. So that's what I would call a cyclical longs in an infrastructure space, which has been hit massively, very high quality. And on the other side, we are short Fraport. They are operating the Frankfurt airport, which is a big hub. But those guys came into the crisis with a very weak balance sheet already. They had like 3 times net debt to EBITDA. They had no free cash flow coming into the crisis, which is not like Eiffage on the other side. So even if it's not a pair like airport infrastructure against airport infrastructure, it's viewed, in my view, as within the block, within infrastructure, you've got a very long quality balance sheet, not expensive name. Again, what I would say, not expensive, but very bad balance sheet and probably less of a V-shaped recovery versus traffic on the road versus traffic on the airline. So there's no, it's hard to summarize in one line or in 2 minutes the way we manage all those risks, but we constantly look at the baskets, value baskets against growth baskets, high quality, low quality, 3 months momentum, long and 3 months momentum shorts. Today, for instance, is a massive day of 3 months momentum inversion. So there's a 6% move of the basket of Morgan Stanley and 3% or 4% on the Goldman Sachs baskets, which means that in those types of days, when it moves by 6%, which is two standard deviation, you need to be prepared for these types of moves. Consequently, to be prepared, you pick your longs and your shorts, but you balance the portfolio on a regular basis, sometimes using as well sector shorts, which is something we use, to neutralize as much as possible all those factors that are external to what I would call the pure stock by stock picking.
Okay,
Thank
thanks,
you.
Fred.
Yeah, we open up for questions. So if you want to make any question, please use your chat, and we will have the question for the portfolio managers. Maybe just a point, a tough question maybe. So of course we have seen a huge downturn for the market and then a huge bounce for the market, in particular in the US. Do you think Europe will follow US, or is US going to adjust?
No, listen, I think that the correlation with the US in terms of direction is usually pretty high. That's point number one, even if the magnitude is not the same. From an earnings, I mean, the central banks have put 7,000 or 7 trillion dollars in the system. The European fund has basically passed now almost, or we still expect to be completely voted. But you have a green recovery or a green fund. You have stimulus all over the places. So we've seen what is very rare: 90% or 95% of the time you retest the lows. This time so far, today the S&P is above the 200-day moving average, and we've not retested the lows. So it's been a complete V-shape, driven to start with by what I would call quality stocks, and we are long, as I said, a lot more quality, visible growth, because when you don't know where the earnings are going to be, that's what goes up first, quality and visibility of earnings. And now we're in the second phase where the breadth of the market is expanding. So the US has been driven over the last few days by more value and than Nasdaq, and you can see that a lot of these sectors that have been sold massively in travel and leisure, in airlines, in the casinos in the US, same in Europe, have been rebounding pretty hardly, despite the fact that some of them are still in need of equity, because we've seen a lot of, probably in Europe, we've seen 8 billion of equity raising, but there's probably more to come. But just because the economies are reopening, and on the 2021-2022 earnings, some of those stocks, the one that are, I would say, have a balance sheet that is, or number of shares that is pretty safe, but some of them don't look that expensive. So we are wary of the fact that it's rare not to retest the lows for the market, and I'm not betting on either we are going to be a V shape and is going to continue, or we're going to retest the lows. I think the probability of retesting the lows is now much lower than it was, just because the market is finding more breadth. It's not only driven by the FANG or the granolas, which they call in Europe, the granolas being the equivalent of the FANG in Europe. So, you know, the high quality growth stocks, but it's getting more, the breadth gets more, there's more participation within the market. So I think that the risk is not to be too short value, and we are paying attention to that as we speak. The chances is that the worst is probably behind us. Doesn't mean the market is not going to come off a bit, but I don't think we are. I think we've passed the worst, and there's just too much money going on, being printed everywhere. If you look at the credit market, the way it repaired, they repaired the credit markets. The central banks have basically overnight decided that the high yield index will basically be bid for by the central banks. So when you buy all those asset classes that are what I would call high yield, mortgage backs, and so on, you put a floor to all those assets, and then the bonds move up, the junk bonds move, and then the asset allocators have to basically buy equities, and that's what we've seen since the bottom of the market, end of March. It's been very violent, but I will say that now what's very hard, the challenge is to manage the rotations, because you're seeing this rotation being absolutely huge in Europe. We had today, I think, the biggest day ever of 3 months momentum inversion, being the bad stocks going up, or the stock that were performing poorly going up massively, and the good ones going down. So that's the challenge of the long shorts, and not only us included, is to basically manage those factors and muddle through, as the visibility of the earnings is still pretty low when you speak to companies. But you know,
it's a good point that you've got no visibility on 2020 really, and most people are looking through 2020. So are you going to evaluate a company on 2019 or 21? And I think we've moved a long way, but I agree with Fred. We are probably likely to follow the US rally, but probably in a more volatile way, which, you know, I think positioning wise is probably good for this fund overall. But yeah, it's always going to be hard work.
Yeah, it's a hard work. It's a hard work to basically try to be neutral, especially that sometimes you have stocks within the same sectors that you think have a beta or a volatility which is similar, but the reality is that the dislocation has been so abrupt in some subsectors. I mentioned one of them in real estate. Some real estate stocks are expensive and won't be impacted that badly, but some are just, from a balance sheet perspective, in such disarray or in such bad situation that they are, you know, trading on 70% below net asset value. So the question is it going to go bankrupt, or is it going to bounce back by, it could double in a matter of days? So that's why we've closed some of the short, which were very extended to the downside, and that's a challenge. The challenge is really to avoid being short names that are very highly shorted, that are potentially going to have to raise more equity, but the volatility of those names, because they trade like options, when you have 1 billion equity and 6 billion debt, for instance, it gets very bumpy, very risky, and the volatility gets higher. So yeah, it's almost like you know, you need to be like a surgeon. It has to be very, very precise at the moment.
Thank you. So we have a couple of questions. One very straightforward. So do you use indexes, futures for the short side?
Yes, we do. So we have a combination. Yeah.
We have a
combination. Single stock options.
Yeah. So single names and sectors as well as the market. We don't have more than 12-13%, which is basically index, what we call index. So we do use them, even if the majority is still single shorts.
Okay, the other question is who takes the final investment decision? So I'll start with Paul, and then maybe also there is an answer from Fred.
Yeah, so I think the way we run this fund is Fred has all the experience of the European stocks, so as you can see from the call today, got really good in-depth knowledge of European stocks. So, if Fred recommends something, there's a 95% chance it's going to happen. And that's actually been pretty good for us so far, hasn't it? But like the whole of Tellworth, I guess, every fund has a kind of backstop situation. So I'm an experienced fund manager. So when Fred wants to do something, he runs it by me. Nearly all the time I'm saying yes. Sometimes I might say no, but that's the way we run it.
Yeah. So at this point in time, we don't have other questions. So I think we cover pretty much the strategy and the portfolio. Of course, if you have questions or you want to follow up, just let us know. And thank you, Paul and Fred, for your time today. Thank you, everyone, for joining.
Thank you, Laura. Thanks a lot. Bye-bye, everybody.
Yeah, thank you, Laura. Yeah. Thank you, everyone. Goodbye.
Goodbye.